Hey guys, how's it going? I hope you're all doing well. So in this video, I was thinking of doing something slightly different to my usual videos and share with you guys my current Trading212 INVEST account. I have a very special name for this account and it's called Not So Subtle Stock Portfolio, and you'll see exactly why I call it that. So I have this account with Trading212 for about nearly 3 months. Thanks to my brother for the referral code. I do, however, have my normal ISA account where I invest a certain percentage of my monthly income straight into some ETF and mutual funds. Those investments are slightly boring. They are all into funds, so I don't really check them out every day. I would maybe go into my ISA account once every week or once every 2 weeks. So the opposite of that account is my Trading212 account, which I mainly use for stock investments, not so subtle stock investments. So I have about 15 different stocks in there at the moment. And the reason why I'm using Trading212 is because I do love the fact they don't charge you anything for trading. It's absolutely free. They don't even charge you like a management fee. So it's, the cost is literally zero for me. And compared to them, HL, they charge you about nearly £13 per trade. So yep, I'm not using them to do any of my stock trading. So if you do want to open an account with Trading212 after you have done your research and you do want to open an account with them, feel free to check out my referral code in the description box below, where if you do open an account with them, we can both get a free share worth £100, I think. Yeah, so that's that. So back to my not so subtle portfolio. I will only add a new stock in this portfolio if they meet at least one of these 3 criteria. So one of them has to be they are currently unloved. So they've had a very short-sighted market reaction where the stock price sold off against its valuation. And secondly, they would need to have some really good quality metrics, either now or expected to be in the future. So for example, I would look into metrics like ROE, return on equity, or ROI, return on investment. And finally, the stocks needs to have still a lot of potential for growth, either organically or inorganically, like through M&A. And I try to look out for stocks that are within an industry with a lot of tailwinds. So with this not so subtle portfolio, I have given myself a budget of £10,000, and I don't want to add any more money into it, mainly because it does not have the tax advantage. As I've mentioned, it's an invest account, not an ISA account. The reason why I have given myself the 10k budget is because even if I do double my money, it will still be below that capital gain threshold. And if I take a very punchy annual expected return of say 15%, it will still take me at least 5 years to double my money. So who knows what I'll be doing by then with my Trading212 account. Anyway, that's enough of me talking. Let's get right into the stock portfolio. I do have reason behind why I hold each and every single stock in this not so subtle account. Obviously, I cannot go through all the stocks because we're going to be here for a very long time and you'll be bored and YouTube is not going to like that. So I'm going to try to talk through at least half of them, so like 6 or 7 different stocks. By the way, before we get started, I would really appreciate if you could hit that like button for me and subscribe to my channel if you haven't done so already. So first one is the Alibaba stock. I have paid an average price of $264 for this stock, and my expected price target over next 12 months is about $350. I mean, a lot is going on with Alibaba stock, right? You first had the problem with anti-IPO not going through when the stock, firstly got hammered, and then you've had the, the news from US where the ADR is likely to be delisted for people who are investing, outside of China, and Alibaba ADR is how we invest in this company. They've also had other problem with the Chinese government itself, when they were drawing up the anti-monopoly regulation, which is, impacting Alibaba stock. And most recently, I think they have been fined about $70 million, again, for audit reason from the Chinese government. So a lot is going on with Alibaba stock, but that's precisely why I find that it's a really good opportunity to kind of get into that business. So in my opinion, Alibaba is a very solid business, and if the stock price of this company keeps falling for next few weeks or so, my plan is to keep buying slowly. So that's exactly what I did. So when the stock price initially dropped, I did not just put a lot of money into it. I started to buy very slowly. Basically, I was doing a lot of dollar cost average with this stock, and that's actually helping me out. So why do I like it? Very briefly, this business is extremely profitable. It's a really solid business, lots of growth. I mean, just look at the revenue number and the net income number. I think year on year the core revenue growth was 35% for Alibaba. 62% comes from their cloud computing side. Their ROI, so return on investment, is nearly 20%, which is a really good number, and that's the type of number that we as investors should be looking into. ROI number is essentially the net income, so the profitability of the company above the cost of your investment. So that's how much the company is generating in profit per amount of investment that you put. So higher the number, the better, and the number of nearly 20% is actually really good. In terms of the valuation though, yeah, it is quite high still. I mean, the current valuation by earnings, so the PE ratio, is about 27 times, and it is expected to be by 2022 about 18 times. And the vision for Alibaba is really long term. If you open their financial statement, you would see the first thing they would say is they're thinking for next 100 years. So that's an extremely long-term vision, which is really good for investors. And so if you kind of take that into account, personally it does not scream that it is extremely overvalued at the moment. So this is why I have it. Next in the list, going alphabetically, we have Apple. So the average cost that I've paid per share for this company was $112 per share, and my target or expected price is about 130, say over next 12 months. So as you all know, I think we all know, it's a very solid business. It's one of the tech companies that actually do pay their dividend, and when they did start to pay their dividend, they have grown that every single year, and they still have a very low payout ratio, so about 25%, which is good, right? Because it means they can very well continue to pay those dividends, and they seem to be really serious in trying to increase that dividend. So having a very low payout ratio means they can do that, which is good for long-term investors. I am a long-term investor, so it's good for that because it gives you plenty of opportunity to let the compounding really works in your investment. I'll link something about compound interest and how it helps you grow your money somewhere in this video. So in terms of capital return, as I've mentioned, I'm expecting it to reach about 130 over next few months, like 12 months. So it does not have a lot of maybe upside with this investment, but it is a company with a lot of great quality metrics, which I absolutely love. And I do feel that it has a lot more to go for it. So most recently, I think they have announced 30% year-on-year increase in their iPhone cell production. So that's going to be really positive to drive that revenue. And I think their M1 processor looks very promising and is doing really well against the competitor. It's super fast. So I think the brand loyalty is likely to keep them kind of going much more into the future. So I don't think I can add any more about Apple than that. So next on the list is Fastly. The average price I've paid for this stock is $69, and I'm expecting it to hit about 100 over next 12 months or so. And then I have a stock called IDEX Laboratories. I have paid about $448 per share for this stock. So this company, they develop, produce and distribute a lot of products and services in the livestock and veterinary market. They also have a segment where they produce a lot of diagnostic tests for livestock and pets. And what I really love about this business is that it is of extreme high quality. So their margins have been consistently great. So over the last 10 years, they have had the gross profitability margin above 50%, which is extremely good, right? And that explains why the valuation is actually pretty high as well. But for me, that quality really screams a lot of value on its own. And the return on invested capital also grew steadily over time, which is important. Yeah, so the company is very expensive. They have a huge valuation, but why do I have it? So I feel that, again, this business has a long way to go, and they do have a structural tailwind in the industry that they operate in. So as I've mentioned, they work within the livestock pet industry. Recent research and survey highlighted how there's been an explosion in pet pet ownership, especially after the pandemic all across the world. And even if you look, for example, in the UK, a survey found that nearly half of British people who already owned a pet got an extra pet over the pandemic. And if you look further into the future, what research have highlighted is that Generation Z, so Z, they're called, right? Yeah. So, the really youngest generations, they're likely to have a much higher pet ownership going forward. And there are a lot of reasons behind that. But so this industry, they do have a huge amount of tailwinds going for them. And I love how the company is operating within this growing industry, and they're very profitable, and I think they have a long way to go. Next in the list is IG Design. So I have paid about £5 and 14 pence for each of this stock, and the target price that I have for them is about £9.80. So this is an AIM listed stock, so this stock is not listed in the normal or the conventional LSE London Stock Exchange. They're listed within AIM, which automatically means that they're likely to be a bit more risky than your normal UK stock. And there's a lot of reason behind it. One of them is because of liquidity. So this stock, they don't trade as frequently or as much as other UK listed stock because they're not in the normal exchange. Even though it's a UK company, they have about 60% of their revenue being generated from the US market, and they have a really amazing customer base. So Walmart is their largest customer. This stock got hammered right after COVID for no good reason. The company basically manufactures and delivers a lot of different gift items for these retailers like Walmart. So, birthday gifts, anniversary, Halloween, that kind of thing. They have 19% average gross profitability metrics and 9% ROE. And both of them are really good numbers, and the sales are growing as well. So my expectation from this business is really to capture that repricing moment. Next in the list, I have Microsoft. I bought an average price of $208. I'm expecting it to reach about $245. Then I have Nvidia, paid $495, and I'm expecting it to kind of go close to $600 over the next 12 months. And then I have RWS holding, paid £5.46 for this holding. It's another AIM stock, and I'm expecting it to hit about £9 in next 12 months. And then I have Shopify. We all know about Shopify. It's a very expensive buy for me. I think I only have a single stock in that, so that I paid $925. Then we have Snowflake. I have paid $245 for this company stock, and I'm expecting it to kind of reach above $300 within next 12 months. So, okay, maybe I can talk about Snowflake for a bit. So I don't usually buy stocks at IPO or, right after they have been through the IPO. That's because we're more likely to get a really bad deal by buying an IPO stock. So when an IPO happens, if it's a really good company, they usually get oversubscribed by the market participants because they know the company much better than companies like me and you. So I don't tend to go for IPOs, but I did buy this stock like weeks after it was IPO'd. Snowflake, they provide cloud-based warehousing. So as you can imagine, that's a really growing business, and it's gonna be in high demand as we're moving towards more and more digitalized environment. So this company, they're operating in an industry where I am seeing, one of those tailwind potential. So at a recent interview right after their Q3 earnings, the CEO was mentioning how Snowflake is extremely efficient and precise at delivering big data. And another thing that the CEO mentioned was that customers who are kind of within this space of using digital warehousing, they're only using a very small percentage of the big data that is available to them. So there is a huge potential for that area to keep growing. The company also have a growing customer base, and their net retention ratio is extremely high. I think it's about 158%, which is the highest amongst all its peers. So if you kind of compare that number to the industry average, or what is considered to be good, which is about 110%, they are actually operating at 158%. So what do I mean by that? Is that, say if they had a customer who spent $1 1 year ago, that customer will be the same customer, the repeated customer will be spending $1.58 with them. So even if Snowflake does not acquire any new customer, they can still double their revenue in 18 months just by reusing, just by relying on those repeated customers. And just as an FYI, it's not important, but Berkshire Hathaway, so Warren Buffett's firm, they are the largest shareholder in Snowflake. I think they own about 15% of all the outstanding shares. So I think Warren Buffett sees a lot of value in this company still, even though they're not profitable yet. So this company is mainly for the future, so long-term holding again. Next we have Softcat. It's another UK company. I paid £11.48 for this, and target price about 18 or 20 pounds. Then we have Tesla. I mean, what can I say about Tesla? It scares me to see what's it doing. So when I bought it, I paid about $389 per share for Tesla, and I was expecting it to kind of reach 450 or maybe even 500. That would have been the target, expected price target. But it's kind of keep going up, and now it looks even more overvalued. So at this price I would not have bought Tesla. I would not buy Tesla at this price. It just it's kind of screaming overvalued. And I do know I am expecting the company stock to kind of correct itself from next year onwards as it enters S&P 500, because it will come under a lot more scrutiny, and they have a lot of pressure from the analysts now to cut their cost. That's what they have promised to the Wall Street, that they will cut their cost base down so that it becomes even more investable. So if they cannot deliver on that, then expect large correction from next year. But yeah, I'm not touching it, I'm not selling it, and because I'm already kind of sitting on a healthy profit, I'm okay with it for now, and let's see where it goes really. And then I have a stock called Trade Desk, another expensive company that I have bought. I have paid $567 per share. One share I have for this company. So I do love this company. They specialize in programmatic advertising for their clients. So what they do is that they automate marketing spending for their target audience, for their customer, and that has been really helping their customer to kind of reduce their cost as well. So even this year, because of pandemic, there's been a huge push to kind of cut down on advertising for companies. So the market was expecting this company to not do well. However, they have managed to beat the Wall Street expectation this year for every quarter, and that's one of the reasons why the stock price have done so well this year, despite being in a very tough situation. I don't know your view, but there is a ongoing shift towards moving everything in online, and so they do have this tailwind where they can get more businesses for customers who are targeting audience online, and because they have these cutting edge technologies, they can really automate those numbers for their customers and help them reduce their cost. So even if customers, they feel a pressure to bring down their advertising budgets, they would still need to advertise, and that's where Trade Desk can come in and help them reduce their cost for the long term. So they do have that demand for them that's likely to help them continue to keep growing. And just to add a bit more on the metrics, so as I was mentioning, I love quality business. Their ROE and ROI is about 20%. I mean, how great is that? They do also have amazing net and gross profit margins. So their gross profit margin was 77% over last 5 years. That's amazing. They have net profit margin of 16%, which is also great. So that's that. And then I have two more stocks. I have Twitter, which I bought at $44. I don't know how long I'm gonna keep that for, to be honest. Not likely to see a lot of upside, but there could still be. And then finally I have Wayfair, which I bought for $257 on average, and my price target for that is about $310. So here you go. That's my not so subtle portfolio. I think you know why. They're very punchy, concentrated, high risk, growth, quality. That's all I'm kind of trying to look for. And I know they have a huge valuation number. So this is an expensive portfolio, which is why it's also very risky. But I do want to, and I am able to take some punchy risk with this portfolio. I don't know whether I'm going to continue to do kind of update on this portfolio, because I don't know whether it's actually going to be useful for you guys. But do let me know if you want me to. If not, that's absolutely fine. I just wanted to kind of do this as a trial and see whether there's any interest. If you do want to talk about any of the stocks that I have mentioned, let me know in the comment section below. I love talking about stocks. And yep, I'm gonna go now. So until next time, look after yourself and your money.